Into markets actually declined after the Fed rate cuts on Wednesday. The Fed announced they would lower the benchmark overnight borrowing rate by 0.25% to a range of 3.75 to 4%. Now, this marked the second consecutive cut of 0.25%, and there's still one more meeting left this year where we could see another rate cut. The keyword here is could, and the lack of conviction around another cut is likely that what spooked the market. Got him really kind of scared there. Powell said a December rate cut. Well, he said it isn't a foregone conclusion. And while recently appointed Fed Governor Stephen Moran again dissented in favor of a 0.5% cut, well, there was on the other side the hawkish dissent with Kansas City Fed President Jeffrey Schmidt, who voted for no decrease at all.
There was also, I saw, I think her name is Lori Logan. I think she's the Dallas Fed president. She's not a voting member, but she will be a voting member in 2026. Wow. She came out this past week and also said, I wouldn't have cut.
Right.
So she, again, didn't get that dissent vote because she wasn't voting. But again, there is kind of a little bit more rift in the Fed.
You know, and that's an interesting point because I forget the numbers, but I know the board of governors, I think it's like 12 or 14 members. But
14.
14. But then around them, there's like, I don't know, 15 or 20 more that they're not voting, but they still have input. And I don't know how it exactly works, but I'm sure they have some influence.
Gosh, we did a post on that probably about a year or two ago. We might need to pull that back up because it is so interesting, right? Like the Fed that is voting today, you have your permanent voters and your rotating voters. It could be a totally different set of minds that comes in next year, and you don't really know how they're going to vote until they're in that seat. So, I mean, it'll be interesting to watch. And, you know, obviously we got that one dissent from Mr., I think I'm going to say Schmid. It's got the D, the hard D. So I'm going to go with Schmid. Good. His vote and then Powell's language, again, is what likely sent the market lower after the announcement, as many essentially had that December rate cut factored in as a sure thing. Powell also added there is a growing chorus, kind of as I was saying here, among there you go, 19 Fed officials. Not all of them vote. There's 19 Fed officials, though, to at least wait a cycle before cutting again. This resulted in traders lowering the odds for a December cut to 67% from 90% the day prior. So that is, again, I think what spooked things. And I actually pulled what Mr. Schmid said here in a statement. He said, equity markets are near record highs, corporate bond spreads are very narrow, and high-yield bond issuance is high. None of this suggests that financial conditions are particularly tight or that the stance of policy is restrictive. In the end, inflation is the Federal Reserve's responsibility and within its control, and as I balance the mandate and the effectiveness of the Fed's actions in meeting that mandate, my preference was to hold the policy rate steady at this week's meeting. I'd have to agree with those statements.
Yeah.
I mean, you don't have necessarily maybe inflation being as problematic, but you have asset inflation that I think you got to factor that into the equation as well.
And I do worry that Powell is feeling the pressure from the president and not being independent and saying, yes, we'll reduce them, because I don't see why we're doing this, to be frank. And the economy's going along. I just get so afraid of you shooting all your bullets, and then when you need them, oh, gosh, we got none left. I'm afraid of that.
Yeah, well, what are we worried? Unemployment's going to go from 4% up to 4.5%? I mean, it's almost like we can't let unemployment nudge up anymore, even though we're at a historically low rate. I am, again, very concerned about the inflation creeping back in, and I think there has to be that balance, and that means maybe letting the labor market even deteriorate a little bit more.
And you, Harris, and I were talking earlier today that, an economy has to go through cycles. You have to have your booms and busts. I'm sorry, that's the way it is. And when you try to avoid them, you're not ever going to avoid them. You're just pushing things off later, which would be a much worse situation. That's what I'm afraid is happening here, is that we might go another year or two, but boy, there's going to be hell to pay when things actually do fall apart.
Yeah, no, so. I mean, there's definitely a lot of things in the underlying economy that, again, I think should warrant some concern. But if you keep kicking that can down the road, eventually you can't kick it anymore.
No.
And that's when the issue comes.
Yep. Given lack of data and an economy that still appears to be in an all-right position, I do believe the Fed needs to be careful cutting too quickly, essentially, since they are taking another accommodative stance with the announcement that there would be the ending of the reduction of its asset purchases, a process known as quantitative tightening, on December 1st.
Yeah, and this is just another accommodative stance. Everybody talks about the Fed rate cuts, but the quantitative tightening, quantitative easing, it kind of happens in the background. We can talk a little bit more, but it's a much more complex system that goes on, right? The Fed cuts rates to, what do we say, 3.75%? Is that what? Yeah, 3.75 That's very easy to comprehend. The quantitative tightening is much more complicated, but in theory, what it does is it stimulates the Treasury and mortgage-backed securities markets, which should help with longer dated debt instruments, as the Fed was allowing these assets to just roll off the balance sheet and now will need to step in and buy new debt to replace the securities as they mature. While QT, again, quantitative tightening, shaved off around $2.3 trillion from the Fed's balance sheet, COVID led to a major expansion from just over $4 trillion to close to $9 trillion. So yeah, we've come down, but we hit this huge increase due to COVID. And again, the way that this kind of works is the Fed owns all of these treasuries, mortgage-backed securities. And what happens, let's say they had $100 billion worth of mortgage-backed securities and treasuries maturing. Well, before, or I guess currently until December 1st, they were then repurchasing anything in excess of $35 billion in mortgage-backed securities and $5 billion in treasuries. So they were allowing that balance sheet to shrink because they weren't buying those assets. But now what's happening is they're saying we're done with quantitative tightening. So what happens when an asset matures? Well, then they go back into the market and they buy that asset to replace it on the balance sheet. So it creates, I'm going to say, that artificial demand in the Treasury and mortgage-backed security market.
Yeah, and they're now down to $6.6 trillion, nowhere near the $4 trillion when they started. And I get worried about the debt with this, and I'm going to figure out a way to try to make this, because you got the bank reserves involved. I want to try to figure out a way for our listeners, our readers, our viewers on how to understand what's going on. Because when you understand it, we talked about kicking that can down the road. That was what is happening. And again, we've talked before that, yeah, when they reduce the prime rate or the discount rate, yeah, that short term, they realize that. So now they're starting to fool around with longer term rates, which worries me by doing this quantitative tightening. So,
yeah. I mean, it is a concern. And, I was talking to Harrison at lunch here as well. And we were talking about how, pushing mortgage rates down to 3% has almost made it like a 6% mortgage is terrible. Yeah. But in reality, a 6% mortgage is not that bad.
Right.
And you can't have money at sub 3% because that's what then fuels a lot of the speculation. I think that's what could cause a lot of the issues. I mean, maybe that's why, again, you've seen your cryptos increase, you've seen your meme stock.
Oh, yeah.
You have so much money in the economy, in the system, that it allows for these speculative bubbles. And that's where I guess a lot of my concerns come.
The question is, whether rapid expansion just a few years ago was enough removed from the balance sheet to put it at a more normalized level. Like with the Fed cuts, I do believe in monetary policy easing too much. We risk a return of inflation and further increase in many speculative assets, as we're talking about here, that could cause problems down the road. It just, people do not realize some leverage is good, over leverage is terrible, and it's going to cause problems. And you're trying to keep boosting the economy. Sometimes you just need to take a break and let things cool off a little bit. And yes, I know some people lose jobs. Yes, I know some are going to suffer, but you can't keep on with the loose money, because as you mentioned, the speculation, all these things, the higher it goes, the bigger the fall is going to be.
Yeah, I think there is, again, definitely some level of concern that people should have given, again, valuations in the market, valuations in the real estate market. Obviously I brought up cryptocurrencies. That makes no sense. I mean, there's just so many areas of overvaluation. And you listen to anybody.
Yeah.
Even people say, well, I think the market's still going to do good the next year. But, yeah, I mean, things are really expensive. How does that make any sense? And it's like, okay, so what about 3 years from now, 4 years from now? Are we still going to keep saying every single year, like, well, things are just really expensive, but, it's still going to keep going higher? At some point, valuation will matter, and that's where I guess these issues can ensue, as people all of a sudden get blindsided, even though they shouldn't have been blindsided.
Right.
Right. The funny thing, right, is people are admitting that there's a problem, and they're not taking any action. So you're not even getting blindsided by the problem, I guess. You're getting slapped in the face while watching it come. It just makes no sense.
Well, and that's why they say, don't listen to what people say, watch what they do. And that's the big thing. That's true in the economy. Let's talk about something positive, because that's really pretty negative. That's why we're so conservative investing, because we are concerned about the longer term. So that's why we're not buying all the high flyers and so forth. And yes, congratulations, you made money. But again, the risk is there. And what's going to happen, Chase, is eventually going to collapse, and people are going to say, what happened? No one told us. They weren't listening to the Smart Investing Show. They weren't reading.
We were talking about Jamie Dimon earlier, and
Yeah.
he's been talking about this hurricane coming for years, and people are like, oh, yeah, Jamie Dimon, he's crazy. He didn't know what was going to happen. And when he's saying stuff like that, it doesn't mean it's going to happen today, tomorrow, next month, maybe not even next year. It could happen 5 years from now. And it's about creating the system and problems in the system, and then when they unfold, it's an unknown. And then that's when the collapse occurs, and it's like, yeah, I told you 5 years ago this was going to happen.
Yeah. And no one knows when it's going to happen. You just see the situation building over time.